Canfin Homes is the company in focus, and we've got the management joining us to talk about the numbers. Net interest margins have come in at a 7-quarter high. Asset quality, though, has taken a hit from the restructured book. We have Mr. Suresh Srinivasan Iyer, Managing Director and CEO at Canfin Homes. Mr. Iyer, good to have you with us here. Thank you very much for your time. Could you talk to us about asset quality, sir? How much of this hit has come from the restructured book? Just break it down for us a little bit.
Sure. See, our gross NPA has come at around 0.91%, which in absolute terms is around 308 crores. And if you have to break it up, about 96 crores is because of the restructured book. And at the beginning of the year itself, we had kind of indicated that in the restructured book, we are having a slight pain to the extent of about 15%. And this 96 crores is in line with the estimate because we had about 670 crores of restructured book. And the good part is that the entire book has already come out of restructuring in November. So going forward, we don't expect any further pain coming from the restructured book. And as the efforts on the legal side and recovery side is going on, we should see some recoveries coming from the restructured book as well going forward.
Could you put some numbers to it, Mr. Iyer? What kind of repayments?
See, you're talking about regular repayments. We have about monthly collections of 700, but
if you're talking about the
recovery from the restructured book, we should probably, we are expecting around 20-30 crore of gross NPA to come down in the fourth quarter.
Okay. All right. Hi, Mr. Iyer. Good morning and good to see you in. Well, there were some disruptions in disbursements in the last quarter, because of the entire transformation that you were undergoing. And that's why, in fact, it came in sub that 2,000 crore mark out. For quarter 4, do you see it return back to that 2,500 crores in the subsequent quarters? Can it go to around 3,000 crores? That's on disbursement. And what is the AUM growth outlook for this year now? Earlier, we were guiding for high teens. It was scaled down to mid-teens. I think the last number you're talking about is around 13%. So give us that outlook for FY24 and FY25.
Sure. See, in the first month, that is October, we had some, transition issues because of which our disbursement was quite subdued. But going forward now, as you closer to December and all, we're back to the run rate of about 700 crores. That's about 2,100 crores any which ways. And we are expecting that, the Q4 is generally better and March, the final push always comes. So around 2,500 is something we can expect, as you were saying. And once everything settles down, definitely we should look at about 3,000 crores in the next year. So for next year, we are definitely planning around 3,000 crores a quarter, which is about 12,000 crores for the year. So in terms of the next year growth, we should see about 20% kind of a growth in terms of disbursement from the current year figure. In terms of the loan book, yes, you're right. We are right now around 13, and we would continue to, project a 13 to 14% for the current year, considering that we are already a little negative. But in terms of the housing portfolio or the business as such, we are quite upbeat still. And the demand has also been up. So we expect that, at least going forward, we should be back once we are stable on the operational front. We should be back on the, 15% plus, closer to 18% kind of a growth in the next year in terms of our AUM.
Growth. AUM growth of 15 to 18% in the next year in FY25 is what you're looking at. Got it. On the net interest margin front, it's hit almost at 3.92%, which is a 7-quarter high. Do you think you can build on to this? And what is the average NIMs that you're looking at in FY25?
See, this increase in NIM has been mainly because we had our asset side, which was getting repriced because of the interest rate hikes. And because we had a lag effect because of annual reset clause, that's why we've had a prolonged effect. But again, on the reset also, we've almost concluded the entire portfolio, which was to be reset, has already gone through the reset. Going forward, there is no upside from here. And since we are also looking at a slightly higher ticket size and would be offering some attractive rates, so I think, a 3.5% plus can definitely would sustain. But we would kind of give a guidance of not more of about 3.5.
3.5% is what you'll hold on to in FY25, correct?
That's right. 3.5 NIM and 2.5 spread is what we would like to give for next year.
Okay. And the return ratios, what is the outlook on that? Is it something that you can sustain in FY25?
Sorry, can you, in terms of the?
What is the outlook in terms of your return ratios?
In terms of our return, see, we're back to a 2.3 for the quarter in terms of our ROA. And so 2.1 kind of a ROA for the entire of next year is something we can we feel is sustainable, and therefore that would work to somewhere in the range of about 18% of ROE.
Okay. Mr. Iyer, one read-through from your results apparently is that on the affordable side, there is a bit of a demand-supply mismatch. There isn't enough supply, something we've discussed with other companies out there as well. So you're kind of going into slightly higher ticket loan segment. Is that correct? And is that going to be the shape of things to come?
Yes, we are looking at slight improvement in our ticket sizes, because affordable housing, particularly after the CLSS closure, has slightly been a little affected, I feel. And therefore, from our side, even considering that we have been in the mid-20s kind of an average ticket size, moving up would be a better thing rather than going down in the ticket size, because that would require a different segment to be targeted. So considering that our strength is in the salaried segment in terms of the mid-size segment, it would be probably better to move up in the ticket sizes.
Okay. So you're around the 20 lakh sort of ticket size. Move up to what, Mr. Iyer?
We are looking at around up to 30 lakhs for the from 25 in the next 2 years. We would like to touch about closer to 28-30 lakhs.
Got it. All right, Mr. Iyer, you have lowered your dependency on DSA, which is direct selling agents. How do you see this panning out going ahead? If you could give us a percentage, where do you see it stabilizing at?
See, it's not that we have reduced on our DSAs. It's just that we are now also, trying to broad base our sourcing model and our channels, and therefore are pushing more for direct sourcing as well. So right now we have about, in the beginning of the year, we had 85% sourcing coming from the DSA channel, which is for this quarter down to 79%. And in the next 2 years, we would definitely like to have the mix around 60-40, 60% coming from the DSA and 40 from the direct or from the digital channel.
All right, we'll leave it at that. Mr. Srinivasan, thanks a lot for joining in, and all the best, going forward as well. That's Can Fin Homes.